Hedging might sound like something a gardener might do, but it's a really important term in the world of finance and investments. So, here's a short guide that'll help you answer what is hedging and how it works. Firstly, what is hedging? Hedging is definitely a complicated finance topic that makes no sense to most people. But if you're a potential investor, you'll be surprised to know how hedging can affect the world of trade and investment. In fact, all investors need a crash course in hedging before they enter the market. If you're well versed with hedging, you can get portfolio protection in the stock market, which is usually just as important as portfolio appreciation. But it's also important to note that people often discuss hedging without attempting to really explain how it works. This is one of the main reasons why so many people are still not well versed with how it functions. If you're not aware of how hedging works, you can think of it as a form of insurance. So when people decide to hedge, they are protecting themselves against the negative outcomes that can occur as a result of their investment. So they're insuring themselves against any negative events. So you won't be able to prevent negative events, but if a negative event does happen, you've definitely got your funds safe. If you really think about it, hedging happens almost everywhere in the world. Before investing in any form of business, you need to have your money or assets insured. If you buy something as simple as a homeowner's insurance, you're protecting yourself against fires, break-ins, and all kinds of scary disasters that could threaten your asset. Individual investors and corporations also use hedging techniques to protect their businesses. The goal is to try and reduce exposure to the tons of risk out there. But in financial markets, hedging is not as easy as paying a monthly insurance fee to cover costs. If you want to hedge against investment, you'll have to use your financial instruments strategically to ensure that any sudden price movements won't affect your stock. To do this, investors often hedge their investments by making trades in other investments. So if you want to hedge your funds, you'll have to make offsetting trades in securities that have negative correlations. You'll still have to pay some insurance fee, but it'll be worth the trouble. For example, if you're investing in shares, you can buy an option to protect your investment from large moves that could potentially reduce the value of your shares. But if you want to purchase an option, you'll have to pay the premium price. This also means that a reduced risk means a reduction in potential profit. So, hedging becomes a technique that's designed to reduce potential loss and not maximize gains. If the investment you're hedging for makes some money, you'll have reduced your potential profit. But if you lose money in your investment and your hedge is successful, you will reduce your loss. How does it work? If you want to understand how hedging truly works, you're going to have to start with the basics. It's really not that hard, but it's always a good idea to have some financial knowledge before you start. When you're starting, you're going to use financial instruments that are known as derivatives. If you don't know what derivatives are, they work as secondary securities that derive their worth from the value of their primary security. Derivatives are usually considered a part of advanced investments and include options and futures. Futures bind the respective parties from the outset to use the terms that have been agreed upon in the contract. On the other hand, options give the investor and holder the right to purchase or sell the underlying asset or security at a set price before or on the option's expiration date. So if you own shares at a large corporation like Shell and the oil industry takes a hit because of an increase in projects that are based on renewable, clean energy, you'll start to get worried about the safety of your shares. And to protect yourself from experiencing any serious losses, you'll have to buy a put option on that corporation. This gives you the right to sell your shares at a specific price that you have set. This is also known as the strike price. So if your stock price tumbles below the strike price, the losses you face will be minimized, and you'll get your money according to the set strike price. Another way this works is for corporations. For example, if a corporation is worried that they're depending too much on a certain commodity, price fluctuations for that commodity will scare them. So, if a chocolate company relies too much on a certain kind of cocoa bean, and because of high demand, the bean becomes more expensive, the company's profits will be affected because of the hike in price. So, to protect themselves from the uncertainty of cocoa prices, the chocolate company can enter into a futures contract that will allow them to buy the cocoa bean at a specific set price. This price won't be experiencing any drastic fluctuations and might even extend indefinitely into the future. So if cocoa beans become more expensive, corporations can use this hedging strategy to avoid losses in case raw material or essential materials experience fluctuating prices. But it's also important to note that even if the cocoa prices go down, the corporation will have to pay the strike price, which is the fixed amount of money they agreed to pay for the cocoa beans. This means that if the cocoa beans become cheaper, the company will be spending more on cocoa according to their contract. This is why corporations that depend heavily on a certain kind of raw material often have to calculate the future prices of that material before they hedge to protect their investments. And because there are a ton of different types of options and futures contracts, an investor can easily hedge against any stock, commodity, or currency. What are the disadvantages of hedging? If you want to be a pro hedger, you must understand the kind of risks that come along with it. This is because every hedging strategy has a certain kind of cost associated with it. So before you decide to use your hedging as an insurance strategy for your investments, you should ask yourself if the potential benefits outweigh the costs or losses that you could experience during this time. It's important to remember that the goal of hedging isn't to make money, but instead, it helps you avoid losses. It's also important to note that the cost of the hedge, whether it is the cost of an option or lost profits from being on the wrong side of a futures contract, is really hard to avoid. And while it's definitely tempting to compare hedging to insurance, insurance is clearly a lot more precise. For example, with insurance, you aren't completely compensated for the loss you incur. There is always a deductible that reduces the amount of money that you're gaining from the insurance company. Another huge disadvantage of hedging is that it isn't a perfect science. This means that things can easily go wrong when you're assessing risks before you decide to hedge and set up a contract. It's always a good idea to hire risk managers because they are always aiming for the perfect hedge. But a perfect hedge is really difficult to achieve in real life. What can hedging mean for you? Most investors in the market never really trade a derivative contract. In fact, most of them ignore short-term fluctuations in the market entirely. So they don't really care about the whole hedging process. And if you're one of them, you don't have to worry about the details of hedging either. But it's always good to develop your understanding of what hedging is and how it works in the stock market. So, even if you never hedge for your personal portfolio, you can quickly learn how it works. This can help you study the investment patterns of different companies, how they analyze their markets, and how they set their strike rates. And it's always a good idea to study the big guns before you enter the stock market. Example of how a forward hedge works. A classic example of how a forward hedge could work is of a wheat farmer who plants a crop in spring and sells the harvest during fall season. If the farmer feels that his crop is facing a price risk, he'll want to make as much money as possible from the crops he sowed. So, when he plants his wheat, he can sell a 6-month futures contract that protects his crop at a set price. This could be $30 for a bushel of wheat. So the farmer can be assured that even if wheat prices drop, he won't be facing any losses during harvest season. The bottom line, even though taking risks is scary, it is an essential part of the investment process. If you want to be a risk-taking investor, you need to have basic knowledge of all kinds of hedging strategies that can protect your investment against future losses. You will also be able to understand how companies work and how they select their investments. If you want to be a better investor, you need to be an expert at hedging. And with that, we'll end this video. Thank you for watching.